Hello everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to talk about risk in foreign trade, role of ECGC. It's a chapter number 6 from Module A International Banking, CAIIB of Bank Financial Management. Now in this chapter, we are going to learn what is risk and what are the various risks in international trade, management of these risks and various guidelines related to risk management, role and products of ECGC and how it supports export finance in order to help increase exports from the country. Now, ECGC Limited, formerly Export Credit Guarantee Corporation of India, which is a wholly owned by Government of India, was set up in 1957 with the objective of promoting exports from the country by providing credit risk insurance and related services for exports. It functions under the administrative control of Ministry of Commerce and Industry. Now, if you have to define risk, a risk can be defined as an uncertain event with financial consequences resulting in loss or reduced earning. Now, we'll see what are the different types of risk. One is called buyer risk. The seller faces risk relating to non-acceptability, non-payment, and quality acceptance, or credit risk, etc. The other form of risk is seller risk, when the buyer faces the risk relating to seller not shipping the goods after receiving advance payment. The seller, the exporter, may ship poor quality goods and may ship the goods after considerable delay, which may either lead to cancellation or delays in further orders taken by the buyer or even penalties in delays and non-shipments. Now, shipping risk includes risk arising due to the other intermediaries in the international trade, like shipping companies, handling agents, port authorities, local transporters, or even loaders, which may lead to delays or non-shipment of goods in time due to a variety of reasons, like goods being mishandled. Some of the other risk is credit risk, legal risk, country and political risk, operational risk, exchange risk, etc. Now, ECGC adopts a seven-fold classification covering 237 countries. These seven risks can be broadly classified as insignificant risk, which is A1, low risk A2, moderately low risk is B1, moderate risk is B2, moderately high risk is C1, high risk is C2, and very high risk is D. So these are the seven standard classification. Now, ECGC Limited is a credit guarantee institution set up for promotion of exports by protecting the exporters from any financial loss due to the buyer's failure to pay or due to the problem of externalization in the country of import by issuing various types of policies to the exporters. At the same time, ECGC issues various types of guarantees to banks, financial exporters, which protect banks in each case of loss from their advances to exporters. Now, ECGC provides credit enhancement to augment the credit worthiness of exporters so that they could get more and better facilities from banks. Now, in 1957, the Government of India established Export Risk Insurance Corporation to provide credit risk insurance to exporters, which was then transformed to Export Credit Guarantee Corporation in 1964. Now, ECGC was established with the primary goal to support and strengthen the export promotion drive in India so that the trade gap between exports and imports is reduced to minimum. At present, ECGC has set before itself the following objectives: to encourage and facilitate globalization of Indian trade, to assist India's export in managing their credit risk, to protect the Indian exporters against unforeseen losses, to facilitate availability of adequate bank finance to the Indian exporters. Now, the guarantee policies offered by ECGC to the banks are of various types, such as export credit insurance for banks, export production finance guarantee, export credit insurance for banks, export finance guarantee, etc. Now, there are standard policies. Standard policies of ECGC provide cover for exports and short term exports. Small exporters policy, declaration type of policy, it is issued to cover shipments that may be made in period of 24 months. And it is to the exporter who is expected a turnover for a period of 12 months, and it is not more than 50 lakhs. So this policy provides cover against commercial risk as well. Also, it provides risk or protection against political risk. Export turnover policy is the variation of the standard policy for benefit of large exporters who contribute not less than 10 lakhs per year towards the premium. Therefore, all the exporters whose turnover is likely to exceed the premium payable to ECGC by 10 lakhs a year are entitled to avail the export turnover policy. Now, ECGC issues different types of guarantees looking into various needs of exporters and importers. Now, that is also very important. Now, I hope this chapter would have given you a lot of valuable information, and I'm sure this chapter would also help you to clear the exam. So, if you have clicked to watch this video, be rest assured you have clicked a channel. You have reached a channel that will give you a treasure of knowledge. That's a promise. So, please subscribe and become a lifetime learner. Thank you.